Well, hey, everybody. Thank God it's Friday. Got Colin Harper, Brian Peluso, Michael Kutch here with HBK Provident. We get together every Friday right around 12:30, have a chat about the market, some planning topics. Brian, I'm pretty excited about our new studio we have here.
Yeah, well, it's coming along.
It's
certainly coming along. And I think we're going to be using it quite a bit and get some good content out there and relevant, timely content and some timeless planning content as well.
Absolutely. And I think we've just had, we just want to thank all of you for tuning in, watching. We've got great feedback from this show and some of our other videos we've done. It's something we're going to plan on continue doing. We're also looking, I teased a couple weeks ago about an exciting announcement we have. We're going to be expanding our content for a specific group of people and one that's already, I can't wait to share that with you guys here in a couple weeks. But Mike, if you want to swing on by, if you feel like joining this beautiful smog from Canada, come on up. We can get you in the studio too. We'll pull up another seat.
We have a
I think I'm
gorgeous
sunshine down here in Florida.
Well, you guys have the orange glow of the sunshine. We have the orange haze of the wildfires from up in Canada.
Today certainly doesn't look as bad here in the Pittsburgh area, but the last couple of days have been real hazy. So,
my brother lives in Philadelphia. He sent me some pictures. Philadelphia and New York are it's surreal.
That's insane. Yeah, it's absolutely
kind of like a movie or something out there. Not a good movie. So,
any good movies come out of Philly other than Rocky? I think that's the one.
Rocky.
There
was a movie called Philadelphia with Tom Hanks.
Rocky 1, 2, 3, 4, 5. What number are they on now? I guess they're not called Rocky anymore now.
They moved to Creed. They moved to the Creed franchise.
Yeah, so it's not even Rocky. They're just
awesome. Well, enough. We were joking before about Seinfeld. The episode's about nothing, and we've talked about we're bantering a little bit about nothing now. So let's get into the meat and potatoes of it, Mike. What are you looking at? I know it's been kind of a slow week as far as reporting and things, but what piqued your interest this week?
Well, we got to preface this with, as we always do, there's of course a bull market in compliance. So we got to make sure we let everybody know that there's nothing that we're talking about that are specific recommendations for your situation. We're sharing ideas here. You really need to work with a qualified tax professional, qualified legal professional, qualified financial professional to really narrow these ideas down to make them executable at your level. So do not take anything that we're talking about as recommendations or take action on these ideas. If it's something you think makes sense for you, give us a call or work with your qualified professional.
Well,
sharing ideas is what we're doing here.
And I would put one caveat. I would agree with that statement, but I will make a sweeping recommendation on strong dark coffee after you've just had your second kid. So I could safely recommend tons of black dark coffee.
I know we didn't even talk about Zoe. We haven't talked about Zoe. Colin was out for a little bit. What day was Zoe born?
The 20th.
The 20th. May 20th. And so she's working on 3 weeks?
Yeah, going on 3 weeks here on Saturday.
Yeah.
Yep.
Nice. Sleep patterns
are great.
Yeah.
We just don't do it.
They're non-existent.
Very consistent.
Yeah, very consistent.
Very cool. Anyway, so I interrupted you, Mike, but
no, I didn't really start yet. But I think I'm going to stick to the theme about a show about nothing because really not that much happened this week economically or in the market. I think the only real notable economic data was the ISM services, which is still expansionary, but barely. It's just above that 50 level. So we are seeing some deceleration there. Maybe it's showing that the service area of the economy that's been so strong is showing a little sign of weakness, but overall not too bad. Stock market, it's good news that we're finally done talking about a Friday where we're flirting with 4,200. Now the new level is 4,300. So we're slightly above 4,300, but just marginally below the August interday highs of, I think it's 43.25. So that'll be a level to watch. But as of the close of yesterday, we've officially exited the bear market on the S&P, meaning we've risen 20% off of the lows.
Woo! We finally have one good thing.
Now we're not at the highs yet. We're still about 15% from the all-time highs at 4,800, but it is a check mark that we like to cross off there. I found some relief that we did see some broadening out in the past week beyond just the high high mega cap tech stocks. So we started to see some participation out of small caps, financials, some of the cyclicals. But then today, leadership's back in tech. So we'll see if those other areas of the market can gain a little steam. I think that would be a healthy sign for the overall market. But I did see a couple charts that just because it's a narrow market doesn't necessarily mean like doom is in the imminent future. A lot of times what happens is the rest of the market picks up some of the slack. Although before big downturns, you do tend to see just a small group of stocks participating, but it can go either way is my point there. Next week's going to be much more eventful in the economic front. We'll get the inflation data next week, the CPI report on Tuesday, the PPI report on Wednesday, as well as the Fed meeting. So right now with the Fed meeting, it's kind of consensus that we're probably going to get a skip this month in rate hikes and a possibility of one in July. I think the risk is more that they do go 25. I really don't know what the market reaction would be to that. Maybe a little negative. I don't think anything too drastic unless you get a very more hawkish tone out of Powell and the Fed. Like maybe we have to go closer to 6. I don't really think that's the case, but we'll have to see. And then we'll get the retail sales on Friday. So plenty of potentially market moving events. And we'll see if we can bust out of that 4,300 level.
On the upside or downside?
Either way. We'll just have to see.
Yeah, that's kind of a debate that I've been hearing. Is a narrowly led market, which means there's, very few stocks that are really driving the overall performance. Mm-hmm. Is a narrowly led market a good market? Does it indicate a bad market? I don't think there's really a historical consensus on that.
I haven't heard any historical
from the chart I saw. It seemed like a broader participation is more consistent with better returns going forward. But just because, like I said, just because it's narrow market breadth doesn't necessarily mean the market won't do well in the coming months.
Right. Well, the fact of the matter is, when we talk about narrow markets and, the companies that are driving this market, they're good companies. They're doing really amazing things. Absolutely. It's not like it's kind of fly by night companies. And you go back, the technology days in 98, 99, those companies weren't great companies. At least the companies that we're talking about that are really driving performance overall are these good companies doing great things. So I think that's good news overall. But hey, only time will tell.
Absolutely.
We have no crystal ball on this. All right. So Mike's message is wait till next week.
And that we will do. We will wait till next week.
It'll be here before you know it. I mean, that brings us to mid-June.
Yeah, absolutely. Where did the year go? My goodness.
Well, I mean, you're going to be busy, so your years are going to start flying.
My years, years. They get quicker and quicker the older you get.
It's true. It's absolutely true. The busier you are, the older you get, the quicker they go.
Absolutely.
I know that for a fact. Yeah. All right. So what else you got?
We're probably just about the 1-year anniversary of our first Friday Live. I think we started around this time last year.
Really? I didn't even take that into account. I guess you're probably right. We're probably about our 1-year anniversary of the show here.
We should have a little cake or something.
I can't eat cake. I gotta go. I'm carrying a lot of pre-baby weight here. Been working on my before picture for way too long. We gotta try something different here.
Colin mixed up the messaging about pregnancy eating for 2. He didn't know that.
Nice work. Yeah. Well, yeah.
Well, I implemented a new a workout regimen. I've been doing a lot of push-aways. You just push away from the dinner table before you're too full. So it's much harder than it sounds.
Is that a tricep exercise?
It's a tricep exercise. Just fortunately, I grew up in the unfortunately, I grew up in the clean plate era. If it's going to be there, then we worked hard for it, and you got to eat it.
Well, speaking of clean plates, it kind of brings us into one of the topics we're going to chat about today, and that's managing debt. And I know a lot of people, one of the hot topics with debt is people like to go into retirement with a clean plate.
Right.
Now, is that old thinking? Does it make sense to carry some debt into retirement? Or do you think that and we're talking in generalities, right? Each individual is each individual has their own specific case, so it's hard to answer that from just a broad sweep. But if I just asked you, is it better to go into retirement with debt or no debt? What's your answer there?
Well, it certainly is loaded, as if everything we do in financial planning, it is very, very case specific. And if I had to pick one or the other, I would say no debt.
Mm-hmm.
But I think that's way too broad.
Absolutely.
When we're talking about debt, there are certain folks in our industry that lump all debt as the same.
Mm-hmm.
If you owe somebody else anything at any time, that's bad. And that's very case dependent.
Mm-hmm.
If you have debt on, and I'll call this leverage, but if you have debt on an asset that is increasing in value, that's one thing.
Mm-hmm.
If you have debt on a credit card where you bought dinner and you had dinner and you enjoyed it for an hour, and now you have credit card debt on that dinner, well, there's no value to that anymore.
Well, that makes sense. You're talking about the difference between good debt and bad debt.
I am.
Absolutely.
Exactly.
So I think from a broad, so if we look at some generalities, the best thing would be to have no debt, right? In an ideal world, you have no debt going into retirement. I think we can agree on that for sure. But if we kind of build on that, what if that's not a realistic for your situation? What type of debt should we take into retirement? I think it's that good debt, right?
Yeah.
It's things like your mortgage.
Mm-hmm.
It's, maybe an investment in your future or your family's future, maybe a small amount of student loans for the kids that you're helping with. Things like that, I think, are okay, depending on your situation, to take into retirement. But I think it's really important to look at all the moving pieces. I would say 2-3 years ago, you'd be very hard pressed to find me to recommend not taking a mortgage into retirement if you were on the fence about it with interest rates as low as they were.
Correct. Yeah.
Now that math is getting a little more interesting, I would say, and there is some benefit to taking large lump sums to pay down mortgage balances pre-retirement, but it all comes down to your individual situation.
It's going to come down to what your cash flows are, what type of income sources you're going to have throughout retirement, whether they're short income sources or variable income sources. If you got, for example, this is just an example, but if you got a portfolio, you're drawing, say, 4%, and a lot of people argue the 4% rule, whether it's viable or not with volatility in the market. But let's just say you go with the old rule and you're drawing out 4%, but then you got a mortgage at 9%.
Yeah.
Well, so that math's a little bit upside down. And so you got to start running those numbers and say, does it make sense to knock down some of that? Because I'm going to bring in 4% out of my portfolio, but paying 9% out to a mortgage. Well, you got to kind of look at that. Now, if you're paying 2% on a legacy mortgage that you had from years ago when the rates were really fantastic, well, drawing 4% and paying 2% for a mortgage might not be bad.
Absolutely.
I think one of the things that we've seen across the country is consumer debt is at the highest levels ever, I believe. And so what we had was a scenario through the COVID years where everybody was hunkering down and saving lots of money, and the world was going to end and all these other things. Well, the world didn't end, and people started spending.
Well, now the world could end at any moment, so you might as well go out and live.
Well, that's true.
that's kind of I mean, at least like some conversation I've had, that seems to be the mindset shift in a lot of folks. There's a lot of people that were holding off for lifetimes almost on things they wanted to do, and after COVID, a lot of people realized that, you know what, it's time to stop kicking the can down the road. It's time to make quality of life decisions versus financial decisions, and I think a lot of that speaks to that consumer debt number being higher than it ever has, because people are not necessarily making the best financial choices, but they're making maybe the best personal choices for them to do things they've been holding off on for a long time.
Well, we talk about that balance all the time.
Absolutely.
The balance between the art and the science of what we do. The science is very easy. You run the numbers, you get 4%, pay 9%. You run those numbers. That's the science. The art of it says, what is the rate of return on the enjoyment of life? Well, it's a pretty high number, and it's hard to put that into a financial plan. But by the same token, the credit card debt is going up significantly. At the same time, the interest rates are going up. And so you got to be very, very careful about being able to manage that. If you're carrying some level of credit card debt that could easily be paid off by a pot of money, that's one thing. If you're carrying credit card debt because you don't have any other money, that becomes a little bit more challenging. Those are the things that we look to tackle before retirement.
Absolutely.
Because some of that consumer debt becomes a mental burden into retirement. And we're trying to eliminate those mental burdens as you go into that next phase of life, which, you know, you have more free time and you want to enjoy it more. So those are the kind of things that, you know, we look at reducing. What do you think is the best way to start reducing debt? Because there's an argument on this, right? Biggest balance, biggest interest rate.
I mean, personally, if in my opinion, the best way to do it is start with smallest balances to biggest balances, because I think mental victories are important because, you know, going from a decent amount of debt to fully reducing debt to zero, that's a big mental shift in habits, in your lifestyle. It can be, some folks might have to tighten the belt pretty significantly, right? It's not extremely easy for folks to go out and make an extra $10,000, $20,000 a year, right? It's much easier to tighten the belt than go out and earn more. So I would say personally, I think starting with the smallest balances, paying those off first, and, you know, doing what they call the debt snowball, rolling that same monthly
Get some momentum there.
Yeah, get some momentum. I think that's a great strategy, but that's personal, right? If you're extremely disciplined and you don't need those mental victories, which I haven't run into too many people who are that disciplined who don't need
program the same.
I would vote for interest rate. Pay off the highest ones first.
Yeah, Mike's, I think Mike's the outlier here, right? There's a reason Mike does all our portfolio manager for us. He thinks a bit differently than Brian and I. And I think not in a bad way whatsoever, because, you know, realistically, Mike's point, he'll save more money in interest over the long run than.
And that's going to be the science of what we do.
Yep.
The art.
And that would be, and that's my mental victory.
Right. You know, the art of it, you know, the science says, yes, pay off the highest interest rate because you're going to save the most interest. The art of it would say, you know, you might need some mental victories. But hey, again, it goes case specific. It really very much depends. You know, in tackling debt is, you know, there is one simple concept in all of financial planning, and it comes down to short-term sacrifice for long-term gain. And if you need to go through the short-term sacrifice of knocking out that debt for the long-term gain of not having to open those bills every month and having that weighing on your enjoyment of life, short-term sacrifice, long-term gain, right? Bear down, throw every extra nickel at it, whether it's lowest balance or highest interest rate, whatever it is, it's short-term sacrifice, long-term gain. Everything we do in financial planning, I would submit to you, comes down to that. You think about saving for retirement. You save $100 when you're 30 years old, you get to spend, you know, a couple $100 when you retire. Have the short-term sacrifice of pulling $100 out of your spending when you're 30 for the long-term gain of when you retire, you spend a whole bunch more than that if you know, get some return on that $100. So that would be the same. Make that short-term sacrifice for the very long-term gain of not having, you know, that kind of albatross around you throughout your retirement. So we really didn't come up with an answer.
No, there's not really an answer. And I would say just kind of imparting some wisdom that I've learned in my life. Spend money on experiences, not things.
Yeah. Well said.
I think those experiences with your family are much, much more valuable than the getting a new car every year or something like that. Spend money on experiences, not things. We're a very materialistic society. You need a lot less than you think you need to be happy. So if you're in a point where you need to cut down on some of that debt, I just look at my own house. I got a whole pile of crap I'm never going to use. But it's like an astronomical number of items the average American house has. I think it's like over 100,000 individual items.
It's kind of like, you know, George Carlin's skit on stuff.
Yeah.
You know, what's a house for? It's put all your stuff. And then, you know, then you got to get a storage unit to put more stuff.
Yeah.
You know, I mean, yeah, I think Colin's alluding to the difference between buying stuff and living and having experiences. And again, we talk to a lot of the folks that we work with. You know, what is the rate of return on taking your entire family to Disney? You've never done it before. Now you have the time and you have the means, and you get everybody together and say, let's go to, what's the rate of return on that? I don't know. I can't put that in a finance. It's huge.
It's priceless.
It really is.
What is that? The old MasterCard commercials? It's priceless.
Exactly. So that's very well said. In summary, it is very case dependent. we do match the science of it, saying, okay, this is what you're paying out, this is what you're bringing in. Let's look at break-even points. But we also have to be very mindful of the art of the reality of living every day.
Perfect. Well, I'd say we leave it there.
Yeah, let's do that.
Awesome. Well, everybody, thank you so much for joining us here on Friday Live. Any questions, feel free to reach out. Have a fantastic weekend, and we will talk to you all next week.
Be safe. Bye now.
Bye.